The Fed raises interest rates half a point to the highest level in 15 years, bringing the target rate between 4.25 and 4.5%. Welcome to Sin City Crypto. My name is David, and I'm joined, as always, with Robin. And today we are covering the FOMC meeting, giving you an update, and of course, speaking about what ramifications this 50 basis point rate hike will have. Robin, first and foremost, are you surprised 50 came in? That was the overwhelming favorite. But Jerome Powell did say they're currently not in restrictive range. So were you surprised that 75 wasn't there, or are you happy with 50?
No, I think 75 is a thing of the past. We're not going to see 75 basis points any longer, at least not in the near term, barring any kind of black swan event. I think 50 basis points, 25 basis points is going to be the new norm. 75 is off the table. Coming in at 0.5 today was the expectations. The Chicago Mercantile Exchange, also known as the CME, had been forecasting the 0.5. It was almost resounding 80%. So 80% of the traders were forecasting the 0.5 and came in as expected. What we didn't come in as expected was perhaps the future outlook of next year with the target range of the federal funds interest rate. They're targeting an expected 5.1%, which is less than 1% from where we are now. And so if you think about it, there's I think 8 meetings next year. And if there's 8 meetings and you only go up less than 1%, that means there's only going to be 2 more interest rate hikes next year.
Unless they go at a pace of 0.25%.
That's even at 0.25%. There's only 3 out of the 8 months or the 8 meetings. And so he's basically saying we're going to be pausing at some point in time next year.
Now, Robin did mention the FOMC meeting schedule. Well, here it is for you guys to go ahead and take a look at. The very next one is going to concludes on February 1st. So they meet 8 times per year, with the exception of if there is an emergency meeting, which we had none this year. But what's interesting is taking a look back of what we've seen. So out of the 8 meetings, we've seen rate hikes in now 7 of them. Starting back in March with a 0.25 point rate hike, followed by 50, and then 4 consecutive 75 basis point rate hikes. Now, if you're not sure exactly what the FOMC is, the Federal Reserve, what their job is and why this is so important, well, we have a video for you guys to kind of explain the brief history of the Federal Reserve and what raising interest rate means. So without further ado, President Woodrow Wilson signed the Federal Reserve Act into law on December 13, 1913, after the Panic of 1907 forced the government to look to wealthy investors like JP Morgan to bail out the public. Although the Fed currently serves as a conductor of monetary policy and maestro of our economy, price stability, max employment, and interest rate maneuvering weren't part of the original Federal Reserve's duties. They were created simply to make the American banking system more stable and improve the flow of money, which in turn will put the American public at ease in regards to their money being safely held at their local bank. Fast forward over 100 years, and we now have arguably the most powerful entity in the world with the power and capability to sway not just the American economy, but the global economy in its entirety. The Federal Reserve System consists of a chairman, vice chairman, 5 board members, and 12 district presidents spanning across the continental United States. This group of individuals are referred to as the Federal Open Market Committee, aka the FOMC. They meet 8 times a year to discuss and vote on monetary policy. The Fed has 5 main objectives: manage inflation, promote maximum employment, supervise the banking system, maintain the stability of the financial system, and provide banking services. Over the past 12 months, the Fed's main focus has been to get inflation under control by increasing the federal funds rate. The federal funds rate, also referred to as the FFR, is the baseline rate that banks use to borrow and lend money to one another. The FOMC has the power to vote to either increase or decrease the FFR, which in turn increases or decreases borrowing costs to consumers. Here's an example. the Fed increases the FFR by 50 basis points or 0.5%, which makes it more expensive for banks to borrow money from one another to cover liabilities and meet reserve requirements. This in turn causes what's called a ripple effect, where banks pass that expense down to the consumer, aka you. They raise the interest rates on your credit cards, personal loans, car loans, and home loans. This tactic of raising the FFR is so the Fed can siphon money from the economy, which decreases spending as borrowing to purchase goods becomes more expensive, which has a direct impact on prices, aka inflation. The idea is to quell demand, suppress inflation, and stabilize prices. What kind of impact has a higher federal funds rate had on the economy thus far? Let's talk about it. So here is what gets affected when interest rates go up. Credit cards, credit card loans, your rate of interest you pay, new and adjustable mortgages, whether mortgages, it could also be personal loans, car loans, and then savings and CDs. What are rates that are likely to not be affected? Includes existing fixed rate mortgages, existing car loans, and federal student loans. Also, I would, well, before I move on to what Bitcoin and the stock market did, Rob, what are your thoughts on this just in general? Do you think the Fed has too much power to sway the economy?
I mean, you got to look at the structure of the government if that's your narrative. Yes, they have a substantial amount of power. They can influence not only economic growth, but just the dollar value in general. And we see that with the dissection of every word that Powell says, and we see the markets react to it. But that's not changing. That's not going anywhere. So it's irrelevant. We're stuck with the power at V. Now, with that said, now you mentioned all those adjustable rates and fixed rate loans being affected, or with the fixed rate loans not being affected unless you close those loans as of now. Couple things to take away. First of all, it's more expensive to borrow. So you're taking steam out of the economy, but you're not seeing the full implementations of the rate hikes until forecasting out 6 to 9 months. And so we've only gotten in the last three before today were 75 basis points. I don't think we've even seen the cause and effects of that in its entirety yet. And so I'm a little nervous to see what the economy is going to look like in the coming months.
The last four, Robin,
Yeah.
not three.
The last four, yeah.
Unprecedented.
So I'm curious to see, what is the economy going to look like? Can we hold fast in this stability where we're not having massive layoffs? We're seeing layoffs, but those are trickling in at a slower pace than expected. But that also goes to show you that we have a smaller labor force due to retirements as well. And so, this isn't a big puzzle that we're trying to figure out what the direction of the economy. But the biggest takeaway today is that the federal interest rate hikes are slowing. And we went from 75, 75, 75, 75. We finally had a reversal from that number, and we're trending back down towards 0.5. I wouldn't be surprised to see a 0.25 next meeting come February.
We'll see. And, as far as some other direct impacts that this Fed meeting and the interest rate has, let's first take a look at Bitcoin on the 15-minute chart. You can see here at 11 a.m. Pacific Standard Time, the rate hike was announced, and we saw a massive candle to the downside, which if we measure this candle, we looked at a 3% candle. Now remember, that might not seem like a lot, but 3% in 15 minutes, lots of volatility. And if you go over to the Dow Jones, same thing, big red candle on the 15-minute. The Dow Jones, this one did go down, if we take a measure here of the candle, less than 1%, which in terms of the traditional markets is considered extremely high in just, let's just say, a couple hours, let alone 15 minutes. And so coming out of the Fed meeting, Jerome Powell did have a press conference. Like Robin mentioned, he did talk about the new target range being in over 5%. So that means we'll probably get another 100 basis point hike in total in 2023, unless that target moves, which means more money being siphoned out of the economy, which means mortgage rates going higher, which means credit card payments and credit card interest rates getting higher. But there's a lot of events that could unfold that could make the Fed pivot, including the end to the Russia-Ukraine war, including the end to lockdowns in China, and just overall the employment, the job vacancies, and the real wage growth coming more into kilter based off of what it's been going through, which has been completely off kilter. So safe to say the outlook for 2023 and moving forward, in my opinion, is a little more clear, is a little more better. 2022 was definitely a rough year. But moving forward, I think we're going to see a lot of positive movement and a lot of green ahead. That'll do it for the video today. Make sure to subscribe and join us Monday through Friday at 10:30 a.m. Pacific Standard Time. On behalf of myself and Robin, thank you guys so much for watching. We'll see you in the next one. Peace.